Welcome everyone to today's webinar titled The Guide to Bank Pricing, Navigating the Range. My name is Lee Patton, Assistant Director of Business Development here at Strategic Treasurer. Today, I'll be joining the discussion with Craig Jeffrey, Strategic Treasurer's founder and managing partner. We also will be joined by Kristen Cifaldi, our Director of Product Development and Analytics. Kristen will be providing her insights and the methodology that was used in publishing the Feenix Guide. Today we're going to discuss how to ease the headache of understanding bank fees with the use of the Feenix Guide to Bank Pricing. Our goal for today's webinar is to give you greater understanding of bank fee terms, context, and computational methodology that we used within. With the information presented today, and by purchasing the guide, we hope that it will support your treasury operations by allowing you to gain confidence in your company's fee management and processes, 2, assisting your team in budgeting and to better understand market rates and trends, and 3, facilitating knowledgeable conversations with your bank relationship managers. In today's conversations, we will spend some time helping you understand context and terms within the guide. We'll also discuss the methodologies of our white glove approach. This approach compiles thousands of bank analysis statements and maps line items in a format that allows a true apples-to-apples comparison of fees. Within the guidebook, you will find data presented from the 2021 to 2023 period. The exception to this is that the ECR and negative collected balance rates are using data from 2023. In the guide, you will find detailed analysis within the 8 fee family groups and the associated subfamilies. Additionally, you will see data from both multinational and domestic banks. This should assist in benchmarking your current company-specific bank relationships. Lastly, and most importantly, I'll provide color on how to purchase the guide. Now that we have the discussion framework in place, I will turn it over to you. Craig?
Well, let's get started. So what are some of the terms that you may be familiar with? Some others, this may be new if you're new to Treasury. Account analysis statement, that's a fancy word for an invoice. It's a detailed invoice that has some different factors that allow you to arrive at a price. It was born out of an era where there were no charges. You weren't able to pay interest on bank accounts. And so the value of balances that were left should be counted towards what those fees would be. So it's a complex invoice that banks lay out and provide. So that's the account analysis statement. Think of it as a complex invoice. Earnings credit rate is the effectual or affected rate that you earn for your balances that would be applied to those bank invoices. It's not called interest. It's just an earnings credit that would be applied against charges, reducing the charges. If there's excess, there might be different ways of handling it, but it's a way of compensating you for containing and keeping balances at the bank. Those are two of the first terms that you'll want to know. I'll jump over to Kristen on that.
Yeah, thanks, Craig. It's also great to be here today. AFP codes are an attempt by the AFP to normalize invoice details at banking institutions and help standardize invoices for their customers. And a reserve requirement is a percentage of deposits that must be held in reserve, not loaned out by banks overnight. It's a requirement of the Fed, and historically it's been around 10%, though as of 2020, it's been at 0.
Yeah, it's interesting. If you look at historical numbers, it's been 15% for a period of time, 12 and 10% as we go back about 30 years. So don't rely on AI for getting the dates right on that, but some good stuff. So 0% reserve requirement today. So a little bit more on the context. How do we understand the context of bank fees? So if you're a banker, you look at clients and you look at them in a comprehensive manner. What are they providing to the bank? How are you able to have contact with multiple people in the organization and have a bank to company relationship that spans and goes across individual relationships? On the corporate side, we need to think about bank fees in a similar manner. That's a component of the relationship that you have with your banking partners. And we'll spend a couple slides talking about that. So on the bank relationship side, think about what banks can provide for you. You may have borrowing needs and they provide credit, the fuel that you need to expand, to grow, to have working capital, or to continue to reach out and accomplish your organizational objectives. The bank relationship also covers a level of risk. As an organization, you have a certain risk level, and that feeds into fees and compensation. We'll talk about what that means when we use the term RAROC, or risk-adjusted return on capital. But bankers, if they're good bankers, if you have a good relationship, your best relationships, they'll provide ideas and guidance. You'll ask them about what are others doing like us? What should we be doing? Bankers are talking to many organizations. They see the good, the bad, the indifferent. They have lots of comparisons. And this is good information that doesn't necessarily translate just to fees, but it's part of the overall relationship. Operational quality and support, how well a bank delivers matters greatly to an organization. And there's the fees. What are the fees? What's the price times the value? Or price times the volume as well. So what's the overall value you're getting? What's the P times V? How does this fit in the organization? So the bank relationship is broad. The second part here, we have bank relationship formality. Banks look at you as a corporation very formally. They look at all of the services they provide, all of the credit, and they create a risk-adjusted return on capital. So they adjust it. If you're more risky, they need a higher hurdle rate, a higher rate of return to account for that higher level of risk. This makes sense. Everybody on the call should understand that as treasury professionals, as risk professionals. So they're valuing the relationship. And if it's not above the hurdle rate, it needs to get there within a period of time, or that doesn't make sense for the bank to allocate their time and their capital in that manner. So it's a way of managing how formal a relationship is there. They have relationship plans for what they're trying to accomplish with you over time. Every engagement, every time they come and visit or have a planned call, they create a call report to be formal about what they're learning, what they're doing. And so they're really looking at maintaining organizational connections and making sure that any errors and issues are corrected as well. So we think about maintaining those connections over time. The bank may have a relationship with a company for 60 years. They're not going to be the same people. And so they want to make sure that there's multiple points of contact at the bank. Now, if you're a corporate treasurer, you probably understand some of this, maybe not at the level of formality that bankers do, but understand the context of being important to the bank means you need to value the relationship that the bank has. What are your plans with the banks? Which banks do you want to be important to? Do you want to manage over time? Are you documenting and keeping track of the calls and the discussions that you have in a formal manner so that your organization can keep track of that over time? And then you have multiple people with a relationship on that perspective. More formality is better there, and it's done within the context of what we're covering there. And so with that context, what do we think of this broader perspective on fees? If we start at the bottom, other factors influence the relationship value besides fees. That's really the context of what we just said, and think of that more broadly. When you think of bank fees and bank charges, sometimes people say, oh, the bank is ripping us off or charging too much, or this is out of market. We really need to think of fees in a range and not as a single point. The same a charge for a particular item that's low volume at a high risk company, higher risk company, is not going to be the same rate that a bank charges a high volume user who's extremely good credit risk. So think of fees in a range, not as a single point. So those comparisons have to be proportional and measured and calibrated according to some of those factors. So think of it more broadly and think of it in the context of the relationship. And so at the top, again, we say fees are one component of a relationship, not the only component. And so those are great things to consider. That brings us to poll question number 1. And this one is about fees and codes. There's 2 questions. They're stacked because you can manage it. When was the last time your company reviewed bank fees? Just select which one it was. If you don't know, select the last option there, I don't know, and pick one of the circles. The next one is, how do you use AFP codes, or how do you utilize AFP codes? Select the one that best fits it. Once you've selected it, go ahead and hit submit. And we're just going to look for, let's just say, type Feenix, Feenix, in the chat box if you would like to see the poll responses from today's webinar. We'll give everybody the poll responses if we have, what did I say, 60? I don't know, I'm making up numbers, 60, 75, some numbers. I see people are typing it right. This is good. That's to imprint on your brain the brand we have for our fee management solution. So I hope that's working. It's not subtle. Excellent. And especially if you capitalize the first letter, you get extra points for that. So, Kristen, I'll let you jump in too on this. It looks like this is a group that's pretty well attuned
on top of things.
Looking at their fees, 73% within a year.
Yeah, that's impressive.
They're on it. They're on it. That's great. So this is the audience that's doing it. The people that are not here are the ones that haven't looked at it in 5 years or 10 years. There's a few that are here that are that way. And so I like the answer, who has the time?
Yep.
It can be a distraction. How do you use AFP codes? It's a definitive source of categorization. Almost that's the highest one. And then two others that are pretty close in percentages. Loose guidelines. We don't refer to AFP codes as a reference. And I don't know. So a nice mix there.
Yep.
So if you thought you were alone, you're not alone. All right. Let's continue our discussion. I'll bring it back to Lee. Are you going to go through a table of contents for us?
Yeah, absolutely. Going to get into kind of what's in the guide from a high level, and then Kristen's going to help dig a little deeper. So Strategic Treasurer, we've been collecting and analyzing data for corporate bank statements since 2015. As I mentioned earlier, though, for this guide, the data is going to be from 21 to 23. This data comprises over 3,600 individual line items that we have mapped into 8 product families and 30 subfamilies. Each category of the Feenix guide will include all market regression analysis and then a further breakout of pricing for both multinational and domestic banks. So if you look at the slide here, obviously the first 2 items, the earnings credit rate, DCR, and the negative collected balance rates, that data is from 23, rate specific there. And then our other categories are what we've broken down into the different families. Balance assessment fees, those are also known as the FDIC fees. Banks are not required to pass that on to you, but most do. Some banks have different names for that. If you're unclear, just contact your relationship manager and they can provide some color. General services, collections, disbursements, data services. The last 3 here, fraud services, lockbox, and online portal. Those are particularly interesting to me because we've seen some fee creep in all 3 of those last few years. So that's something definitely that should be on your radar when you're looking into those particular items. Let's see, Kristen, any thoughts there?
No, I just get into digging into some of the data.
Yeah, go ahead. I'm turning it over to you.
Yeah. So here's a sample of one of our charts from the ECR section of our guide. And you can see we've been tracking data from 2023 on ECR pretty closely, as Lee has mentioned. And one of the questions here I need a refresher on quartiles, right? So the first quartile of the data set is the median of the lower half. And the third quartile of the data set is the median of the upper half. So these values are useful for measuring the spread and skewness of your data, as well as identifying outliers or potential errors. For an ECR, if your ECR is falling within that first quartile range, you may want to touch base with your relationship manager and just see what's happening there. Are there other discounts offsetting the ECR? Perhaps it hasn't quite been tracking with the increases we've been seeing in market rates, or perhaps there's an alternative for where you can park your money to help earn a little bit more on it.
You know, a couple things in this chart is Kristen just stepped through it. The purple line at the top is the third quartile. So 25% of respondents were at or above that line. Mm-hmm. And then the blue line at the bottom is, the 25th percentile. So a quarter of the respondents are below. So between the blue and the purple, for all of you math and finance whizzes, that's 50% fall in between those 2 lines, just so you have a sense of where that information sits. And so when we think about ranges of prices, we think about ranges of rates, there's quite a bit of difference. And Kristen talked about skewness, and that's very helpful as you factor that into your discussions with your bankers and you think about the value that you're receiving.
Mm-hmm. Right. Here's another example of some charts from our guide. This one's from negative collected balance. So that first table is 2023 data. We're showing it by average ledger balance. So financial institutions are going to price things out in various ways, and some of it is by how much money you're actually keeping with them. And you can see that Sometimes the rates are more favorable or not, and these are broken out into percentiles. So the 90th percentile means 90% of the data is underneath that, and the 10% falls there. 50th percentile is right in the middle, and then the 10th percentile is the lower 10th. And you can see that those are the lower rates. This is negative collected balance again, so they're going to be charging you for those overdrafts. The other table is illustrative of just some statistical points that we're calling out on all of our product families and subfamilies. So these are charts that you'll see repeatedly throughout the guide for the different data points.
Right. Now bring us to poll question number 2, or the section number 2. It's on relationship managers. So select 1. What is the frequency of check-ins with your relationship manager that you have? So if you're a bank listening to this, you can pick what your normal one is, of course. Everyone mentioned, annual, semi-annual, quarterly. You can pick it to your primary relationship manager if you have 6, 7, 8, or whatever. All right. So check-ins, you can see the spreads pretty good. Quarterly seems the most frequent. Less frequently than annual is extremely rare, which I think makes sense, right? If you're extending credit having services, it should be pretty regular. That's a pretty good call frequency report with primaries. We could ask more details about secondary banks or third banks to see how that may tail off, but this is some pretty good information. All right, we'll continue. So these are some of the fancy charts that Kristen's team is putting together. What does this mean?
So this is a regression analysis of one of our product families, general services, and then it dives into account fees. So account fees include monthly maintenance, ZBA, zero balance fees, and sweeping fees. They don't include specific services such as lockbox or online portals. Those actually have their own sections in the guide so that you can delve deeper into those. So right now we're just looking at those general maintenance. So the blue dots on this chart are actually the average monthly price of every single product for that month. So we don't just have the 36 data points here. We have all of our data points rolled up and averaged into each of those little blue dots. And you can see the regression line is showing that, unfortunately, general services account fees have been unrelentlessly trending upwards over the past 3 years. So regression lines are one of my favorite ways of illustrating trends, and they're used heavily in the guide, and you will be able to see them for each of the subfamilies that we've analyzed.
Yeah, it's great to see how prices are changing over time with in the general market, as well as what you may be experiencing. You may be higher or lower than the trend line. Maybe you've locked in fees for a time in a period of more significant price inflation on bank fees. That provides you some good guidance there. Thanks for going through that, Kristen.
Yeah. And this is our last sample of our tables. This is a box plot. This one is for online portal file transmission costs. So just a quick refresher on box plots for everybody. Box plots are summarizing distribution of a data set. So the thin gray line in the middle, that's the median value, and then it's divided up into quartiles otherwise. Throughout our guide, outliers have been excluded from our analysis. So if you had like a file transmission setup fee for $1,200 or something, that's not going to be shown here to skew the data. Basically, with the box plots, you're looking to see if your fees are within that blue box. And if they're outside of the blue box, it might be time to discuss them with your financial provider. Extreme values are the minimum and maximum values, which you can see at the top and bottom of the gray lines extending out from the blue box. Those are called whiskers.
Yeah, that's great. So what does the entire range of one of the blue rectangles represent again?
It goes from the first quartile up to the third. Okay,
so that would be the middle 50% is the blue, and you said there's a gray line. It's kind of hard to see. It's around $10 in 2021.
That is the median value.
Yeah, that's the median. Okay. And the whisker at the top and the bottom again is?
They extend from your minimum to your maximum values that we're seeing in the data set. So we can see that the highest prices are hovering somewhere between $40 and $50 for file transmission.
And you mentioned that anomalies, certain ones that are anomalous, are pulled out.
Yes.
Because they can skew the data significantly. So
Yep.
you may have prices that are significantly higher or lower. That may be due to a custom reason. But we're trying to make sure that the data is accurate and usable for everybody. So that was most excellent explanation.
Thank you.
Now you can see 3 ECR market fluctuation. We're back to another poll. Has your earnings credit rate increased or decreased in step with market fluctuations? Let's refer to that as like what the Fed is doing. Is it keeping track with the Fed's increase or steady hand? Even though, let's say, the general rates have decreased slightly, even though the Fed has held rates similar. How have your earnings credit rates kept step with market fluctuations? They have, yes. They haven't, no. I don't know. Select the I don't know box. All right, and we have enough information. So, yeah, there's some questions in there. The blue box would represent the spread between the 25th and the 75th percentile. Yes.
Yes.
The middle 50% would be shown in the blue. Yeah, very good, right? And banks will differ. Yeah, so some good information. So let's look at what that looks like. Kristen and Lee, we have a little over half, 56% say yes, it's keeping track. I think that's pretty good.
Yeah, this is good.
This is a well-informed group, a group that probably presses their bankers. Bankers probably like it, but don't love it. But this is certainly a group that keeps track of it. No, 24%. We certainly see well over 24% not keeping track of it. Even with people that are reporting things for ECR, it tends to fall behind that. And I don't know. That's certainly the honest part of the group, not sharing where that goes. We've seen a decline in ECR rates, both ECR rates and intent to lower the rates. We see that in some of the shorter term investments. Banks are less willing to pay rates out in the market, and so that's tracking with ECR. So there's a decline there, even though the Fed funds rate has stayed, or the Fed's keeping their interest rates exactly the same. So those are just some factors to play in, right? There's pricing, there's earnings credit rates. These are all factors that have an influence on what we're looking at there. Well, that's some great information. And we're moving along quite quickly. There's some questions too. Let's hit these as well. Is there a difference between regular account fees and virtual account fees? This is an excellent question. And the answer, of course, is yes, right? There's differences. We've had more questions on that from bankers of late to see what are others charging. Corporations are also looking at that. There tends to be the main demand deposit account tends to be higher than regular account fees. And then the virtual account fees are lower than a regular demand deposit account. Another comment I see in the Q&A box is, what's a reasonable expectation from banks for EC carry forward in this high ECR environment? So the earnings credit carry forward in this high ECR environment. So the carry forward information is sometimes it's tracked on the statements in terms of a number. And sometimes the length of time that the carry forward can work is not shown. It's not shown on the statements. It's some type of agreement. I don't know, do you have any comments on that?
It's not actually commonly shown on the statements. You do see it at some of the larger financial institutions. They'll show the carryover, but usually that's a separate agreement. Yeah.
So we don't know what the reasonable expectation is for that. If you have very high balances and it more than covers, or oftentimes covers more than your coverage, you could have it as an ECR carry forward. You may look at hard dollar interest. You may look at moving more of your balances to an interest earnings environment. Certainly, that would be a good way to go. Let's look at this pricing comparison. We want to share information about doing pricing comparisons. We don't want to give everything away, so make it enticing, but don't share all the years of experience. But so people that want to do things on their own, they've got a few good pointers. But there's some good complexity here.
Yep. I would also we're very proud that we've got 3,600 line items manually reviewed and categorized into those proprietary product families and subfamilies. And I feel that the process has been representative of our overall white glove approach whenever we're working on analyzing bank fees for clients. So we don't rely solely on AFP codes. Not all banks are able to provide them, as many of you probably know. We see items inadvertently incorrectly categorized or bucketed into the 999 miscellaneous category quite often. Also, if you're working with a diverse group of banks, things are coded differently, so you can't get that apples to apples comparison easily using just AFP codes. So, we've done our research. We use bank product definitions, conversations with relationship managers. So we're just really proud that we've been able to roll that data up in a guide for everybody.
That's a good way to look at how prices roll up, because not everyone cares about the individual components. It's like, how much does the car cost, not the car mats, everything else. And so looking those up in families, subfamilies, what does it cost to process a single receipt or a single disbursement? How does that differ across, the electronic methods, ACH or same day ACH, real-time payments, FedNow. And so understanding what that looks like and what the variables are that are fixed as well as variable. I guess the elements that are fixed as well as variable would be a component. And as you look at this is a way to say, to create some benchmarks in your head about what makes sense. And that's one of the nice things about, as we look at this data across so many companies, so many banks, so many statements, we can see how the average costs work. But that can be very different. If you have extremely low volume through a lockbox, for example, the cost per check may be exorbitant, maybe $10. And it would drop to a fraction of that as you go up. But when we think about negotiations, Kristen, you've done this a lot. I've been involved in a number of them as well. There's three things that are mentioned on here. I'd like to talk about those a little bit in terms of what makes sense and why that may make sense. So why don't you start and I'll jump into.
Yeah, so fees, generally it's the 80-20 rule, right? So 80% of our costs are generated by 20% of our line items. So it's good when you start to dig in to get an idea of what is generating the most of your fees, and then to hone in on to be specific rather than just general calling up the relationship manager and saying, hey, can you drop everything by 10% for me, 5%? If you can provide them specific examples of the fees that you think are generating your expenses that may be a little bit out of whack, it's a lot easier for those professionals to go back internally and tweak things and justify perhaps lowering in a very targeted area.
Yeah. So so those who are in corporate treasury groups who may or may not know exactly how things work at banks, and each bank can be a little bit different. When you go and submit and say reduce the price, you're talking to a relationship manager or the treasury sales officer, and they're not the only ones that are involved in how this pricing works. So if you say, I've got 100 price reductions I want, and even if they agree on them, now they've got to go back to multiple product managers and get exception pricing or negotiation. Excuse me. That can be a significant amount of work for not much value. And I don't think that's necessarily fair. I mean, not that we have to, say, okay, I don't care how the bank is set up. Yeah. This is what I want. But also be mindful of what they have to do, because they're going through different areas. And it just seems like let's go after the big items, not trying to, glean the fields, after the grain drops and you send people to pick them up. Don't do that. Leave some there and focus on those items that make the most sense. So as you described that, I think that was really, really quite helpful, in different ways. And, this idea of, we hear people saying, oh, the bank's overcharging or ripping us off. There's a variety of ways that the banks value the business. They have to make money. They may be charging you less than they should based on your risk profile. Yep. You can't compare yourself to the lowest price. I should be paying, the 10th percentile. 90% of people should be paying more. That's not necessarily the case. Now, you don't want to be the customer that the banks make the least amount of money or lose money on, because they won't be customers anymore. But you don't want to pay more than is necessary. You want to pay within a range that you're comfortable and the bank's comfortable. And it should take into account those factors. And so looking at those helps you understand and scale. The other factor on discussing these items is, you can oftentimes make at least as much of a difference on what you're paying if you look at your services. Move to more electronic methods, move to more efficient methods, stop services that don't work, add services that save you operational time. It's not all what you pay the bank, but what your overall operational efficiency is and how can you scale. So in many cases, you should be adding services. Other times you should be negotiating prices. And you may be looking at how can I change my operations to use less costly, more secure methods of doing business. Your bankers want to talk about those. And oftentimes the bank price is far more efficient than you doing it on your own. And so, look to add services that the banks can use because they're excellent at processing that. So trying to balance everything out here between what the banks are doing, what they're good at, how you can maintain, be important to your important banks.
Do you find corporates that have typically been undercharged for services by the banks, when the contract is up, do you feel that the banks maybe overstep in trying to capture some of that mispriced business that they have been servicing?
I'll give Kristen the first crack at that, or I'll take it whichever she wants. Yeah.
I think it depends on the relationship. If it's like the contract is up and it's in the system and then all of a sudden it's like automatically grabbing the prices based on the client size and the risk profile, then you might get too big of a jump. But if you're routinely contacting your relationship manager and you're cultivating that relationship, they'll forewarn you, that the contract is up and you should watch that on your own as well. But if you can work with them in the, 6 to 3 months pending that, then you can help to get favorable pricing. And as Craig was mentioning before, you can get some old services removed that may be cost ineffective and implement new things to help streamline. You can also review internally to look at process. Like maybe you've got 50 emails going out for payment confirmations. They're charging you for each one and you only really need 5 people to get that. So you can work with your banker in advance of that happening to help avoid unexpected jumps, which may just be automated system things.
Yeah, excellent. Excellent point. I think we've come from a period, a long time ago. There was high interest rates, high inflation. Then we've gone to the period of Fed providing significant amounts of money and funds over time, and so that everything was pretty low. Now, if you look back over the recent past, we have probably about a 20% increase in overall inflation that's been compounding. The rate of inflation is down in the mid 4s right now. Food is up 25%. Bank fees are up different levels. So as we look across the board, banks still are paying people who are paying for food, and so there's going to be some increases. So it's smart to make sure that you're not overly suppressing them because the bank will make a huge correction. Say we got to go up 20%. You want to make sure that they're funded over time. You want to have a reasonable progression in your budget. Sometimes it's nice if you had long-term fees and there was no price increase, and then it went there. But it's going to be there's going to be pressure on the balloon that comes out of that. So just make sure it's fair over time. As we look at those items, there's some questions about the size and industry of those in the benchmarks. They're pretty much across all industries, from really highly intensive treasury organizations with payments, so insurance companies across the board, manufacturing, healthcare, pretty much touches every vertical, and it's across time. There's another question about how does the bank define the capital when they calculate the risk-adjusted return on capital. Now that's a great question. That's a question that's going to be a little too long to answer, but when they look at the capital that they put forward, the capital they put at risk and that they're using to support your business, this is where they calculate. So one aspect of it, and there's formulas so you can see where those come from, but some of the capital is direct credit you're using, or guaranteed lines of credit that you can tap. There's also operational credit that they extend. It could be for ACH services, wire services, for daylight overdrafts. They have to reserve capital for that. So there's more information you get to look at that. And you can also ask your banks on that. What capital, how do you, what does our risk-adjusted return on capital look like? They're not going to tell you that necessarily, but they could say what they look at from a credit standpoint, what they extend to your organization. But some really good questions. And then this one's fit for you, Kristen, if you think it's something we can answer in the time left. How can a company compare bank prices when each bank uses different AFP codes for similar services? Right?
That's why we don't use the AFP codes extensively. So it's hard, obviously, to compare things. We have the guide that we've created, which you could utilize because we've taken that step out of it, right? We've neutralized kind of that noise within the AFP codes by doing our own research and chatting with the banks we have relationships with to get those fees all apples to apples and bucketed properly. The other way you could do it is to manually do that. Assign an analyst to that task to look at your rates and create your own codes internally that you can map things to and maybe run them through if you have a business intelligence tool or other database. It's not a super easy nut to crack, depending on how large those relationships are.
Great. So how do we get the guide?
It's really easy. I believe there's a link in the chat right now you should see. You can also go to strategictreasurer.com/pricing. You order, we will invoice you via email. There's secure ways to make payment. You will provide us with the access and we will provide the credentials for those individuals. It's a year subscription. There's a mid-year update with data and color on ECR and fees, and that's provided too as part of that subscription. And also I need to mention, Kristen has prepared a webinar. It's brief, it's 3 to 4 minutes. That goes a quick overview and how to use, and we can put that in the chat as well. I just want to leave you with a few thoughts, and I think Craig and Kristen provide as well. Looking at this, my takeaway is, all corporate practitioners are in a symbiotic relationship with their financial service providers. It is up to you as the treasury professional to make sure it remains mutualistic, not parasitic. With that being said, I think it's essential that you carve out, in your monthly operational task, to understand the fees being charged and monitor the cost. You got to review the cost of capital needs versus usage of those credit facilities. And also to determine if your banks are helping or hurting your operations. I believe that this Feenix guide gives you the advantage of data knowledge and pricing so that you can confidently approach your relationship manager and interact in an informed manner. So I think it's a terrific tool that should help your day in, day out work and just staying on top of things. Kristen?
Yeah. To add to that, just remember that 80-20 rule. Examine the details on those line items that are driving your expenses and just focus on those impactful items when you're reviewing your fees. And then also really focus on any changes internally in your behavior that could matter. I mean, look at those repair, charges that if they're spiking, is there something you can do internally? Are you getting faxes and paper statements that you don't need? It's a crazy amount of people still are getting things mailed, again, stuck in a drawer somewhere. It's really some interesting stuff.
For extra credit, Kristen has mentioned the 80-20 rule. What's the formal name for that? I put in the chat box. First two people are considered winners. So, and the last point here on how to proceed, whether you get, be methodical, whether you get assistance to do this, there we go. Close. Not quite on spelling, but pretty close. Pareto principle, awesome.
That's right.
So whether you do it on your own or you get help, follow a strategy that takes into account the overall relationship. And be specific as you're asking for things. Make sure you know the value of the relationship banks that you have that are really important, those that you want to keep important over time, those that may not matter as much, and make sure you follow up. And then, when you receive the results, continue to share those internally. As you add more services that help your organization be more efficient, as you optimize your pricing, this can make a significant difference. So thanks everybody for typing the answers. The Pareto principle is the one. And thanks for spending some time with us covering these topics.
Yeah, thank you, Craig.
Yeah,
thank you, Kristen, for your insight. It was very helpful. To learn more about the Feenix Guide, you can actually click on this slide here on the Order Now. There's a link in the chat. I can be reached at the contact information there on the screen. We hope that this was informative, and we'll see you again soon. Thank you.
Yeah, thank you.